All right, well, thank you all for attending this month's market update webinar. This month, of course, is October. I'm going to start with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed in the presentation. And of course, past performance is not a guarantee of future results. You can see more disclosures on my website. And throughout the webinar, you can submit any questions using the Q&A button at the bottom of the screen. Really short summary about me. My name is Jeremy Eppley. I'm a chartered retirement planning counselor, accredited portfolio management advisor, and accredited investment fiduciary. You can learn about more about my experience and qualifications on my LinkedIn. And Silverstone Financial, the firm, is a fee-only fiduciary registered investment advisor located in Owings Mills, Maryland. We do wealth management and financial planning. And if you want to learn more about the firm or the services we offer, you can check out our website. So hopping right into last month's notable events, there weren't that many crazy events that happened, yet the market was very volatile. We'll definitely get into why that was. But the first major piece of financial news that came out of the UK, other than, of course, the Queen passing away, was the UK's ill-advised debt finance tax cuts that happened with the new leadership after Boris Johnson left power. And this was terribly rebuked by the international markets. There was horrible fallout. The pound dropped. The UK bond yield spiked, which is negative. And this forced the Bank of London, their central bank, to come out very quickly and have to intervene, started buying UK government debt to stabilize their bond markets. And it's just an example, and there have been many across the world, of bad handling of inflation. Again, inflation is an international problem, and the US, while not perfect, is ahead of the curve in comparison to a lot of the other parts of the world. Of course, UK is in Europe and is more subject to the fallout from the Russian-Ukrainian war and the supply chain issues that come from that. So they were in a worse position already, and policy mistakes made their markets worse. In general, clients of Silverstone Financial don't have deep exposure to the United Kingdom, maybe a slight exposure because of investments in developed markets, but nothing particular to the UK. Now, bringing it back to the US, we had an unexpected high inflation data read that was released in August, or in September, for the month of August. Remember, this is almost 2 months old data now, because we're talking about it in October. It was released in September, and this was backward-looking data for August. But the data came out at 8.3 annualized inflation, and 8.1 was expected. You can see the data reads for inflation over the past year and a half, 2 years on this graph, and it peaked at 9.1%, and it had a great drop in July, and that's when the markets rallied significantly. And then it still continued to drop, but not as much as expected. And that triggered a lot of negative sentiment, and also fears for the Federal Reserve tightening aggressively. And with the Federal Reserve, the next notable event, of course, was they had the rate hike, which was expected in line, nothing surprising there, but their guidance was extremely hawkish, which means they're afraid of inflation. They want to tamp down on inflation. And there are a lot of fears that they're going to over tighten, push us deep into recession, all of these negative possibilities, which I'll definitely talk about significantly at length farther on in the presentation. Now, the last notable event is still going on, is the Hurricane Ian and its impact to Florida and the other neighboring states. Horrible what I've seen so far. Loss of life, I think it's 43 last time I saw the data this morning. And yeah, it's been devastating to many people in Florida and the Carolinas and all that. And hopefully the impacts to those people's lives will be extremely significant and will be recoverable. So we shall see how everyone gets out of that. I wish them the best. All right, going into performance data. This chart got redder from last month. This is year-to-date 2022 performance. Still only having energy, green, and healthcare mixed. Everything else being bright red. Last month, we had gotten the S&P 500 into the mid-teens, negative mid-teens, and we see that it has dropped way back down again significantly. S&P 500 down almost 25% for the year, which is very significant. A lot of portfolios are hurting. There's a lot of panic in the markets now. I've seen quite a few clients or prospective clients or friends talk to me, and they are not too happy what's happening in the market, but stay strong. We'll recover eventually. The bonds, which is interesting to see, is almost exactly half of what the S&P 500 and the mega caps are doing. So still down, which is expected when rates rise, but we've seen the volatility at about half of the stocks, which is worse than expected. You would expect bonds to have stronger store values, but because of rate hikes, we would expect bonds to fall. And so that's kind of what we're seeing. And it's very interesting, unique situation, because not many times in the stock market's history do we see both essentially high inflation and rate hikes. Of course, it happened in the 70s and some other times, but we've been spoiled for the past 10 years with a great bull market and have forgotten some of the normal mechanics of the markets. So that is likely to continue. Gold is down 8%, still somewhat what I would expect, but still possibly undervalued for the potential inflation hedge that it provides. And crude oil, if you remember, just a few months ago was up 50%. It has fallen dramatically. The stocks, the energy stocks have remained resilient. They've fallen, but still remained resilient, versus crude oil is almost back to where it was at the beginning of the year, which is very interesting. And Bitcoin has remained about the same, about down 50 or 60%. But for switching to this month's graph, Bitcoin actually is the best performer, other than gold, but almost the best performer out of every of these indices, which is surprising to see. Of course, it's still down, but there has been quite a bit of selling off of all of these risk assets. So all the stocks was sold off mostly right after the Fed meeting, which we will discuss. But Bitcoin, which is considered a risk asset and is correlated to the markets and is seen as more risky, higher beta than the rest of the market, it did not sell off as much, which indicates to me is possible resistance point, possible support level rather, and it could mean that that's a bottom for Bitcoin. That's the intrinsic value. Of course, there's not really intrinsic value for cryptocurrency because it's not a productive asset, but showing that that is around the $20,000, $18,000, $19,000, $20,000 level, where it won't fall below that even if there is a rebuke of risk assets. This month was quite terrible. S&P 500 down almost 10%, small caps down 10%. Again, global markets performing worse, albeit slightly, but worse than the rest. And bonds down still 4%, which was just everyone rushing to cash, it seems. So it's very interesting to see all this. Crude oil down over 10%. It's still recovering back to the original levels at the end of the year, as I mentioned. Switching back real quick to the year chart, this is almost back to flat, and it's pretty significant how crude oil is falling. So with crude oil, of course, it's linked to inflation. Is one of the causes of inflation is the commodity prices, and that's one of the main commodities that is falling. So it's very interesting to see, and it's good news in general, depending on points of view and such. But for the markets, at least, crude oil falling has been good, even though the rest of the market has fallen. So before we talk about the Federal Reserve, I have quite a bit to say, but I wanted to bring up this chart that I had made. And I think it's an important reminder because not everyone always thinks about the markets this way. Remember, the markets are secular. They are seasonal. They move in patterns. And it is common for specific months or specific quarters to perform better. Many of you might have heard of the Santa Claus rally, which happens very consistently right after Christmas. It's a phenomenon. It's not exactly explained. There's some theories that traders are happy because of presents or bonuses or just general being around family and such, that there are run-ups in the end of December. There's also similar causes in November after election cycles that there's, okay, the world didn't blow up, and going for November having great returns. But not every year is an election year, and it also has to do with other factors in the markets. But it's important to note that September is the worst month on average consistently. Now, on average, it loses 0.5%, we're down 10%. So of course, we're an outlier here, but that's still a natural drag. People go into the month knowing that this month likely would not be good. Traders know of these trends, which is very interesting, is something I find extremely interesting to look at in finances. People find these trends over time and they become known about, and there's kind of a self-fulfilling prophecy that, okay, well, since expectations drive a lot of the markets, you have the expectation that this trend did happen, so it will happen, so I will trade accordingly. So I'll either buy less or I'll sell some, and then it perpetuates. So it's important to look out for that. And I feel bad. I should have brought this up last month during the up cycle of August, and saying, well, remember, September is oftentimes the worst month, and we expected about that. Now, all that being said, this month was particularly terrible, and let's talk about why. And it has to do with the Federal Reserve. So the Federal Reserve meets 10 times per year, I believe, and they have their projections released, not every single meeting, every few meetings, I think it's per quarter. And so the last projection they had was in June. And in general, I felt pretty positive about the projections. I agreed with their plan, essentially. Of course, these dot plots don't represent a distinguished plan in their eyes, but it shows where the voting members of the Federal Reserve have their heads at, where they expect, and oftentimes that's what materializes. Now, for this June report, it was expected about in between 3 and 4, about 350, low threes is where we would end the year. Now, that was before the bad inflation report that came out in September, which wasn't that bad. Essentially, there's just been some negativity among the Federal Reserve, and from my opinion at least, they want to show that they're committed and they're trying to have a strong arm to be able to dictate to markets, yes, you should listen to me, because there's credibility. The markets follow what the Fed says as long as they believe that the Fed can follow through with it. Now, if switching down to what came out in September, they had their new release of economic projections, and it looks almost the same, but they added an extra row. It's moved up almost an entire percent. So end of year 2022, within 3 months, is an additional 100 basis points, an additional 1% of rate hikes, which is huge. It is massive. And that's just for the end of this year. Now, looking at 2023, we're hovering around 4. Now it's solidly consensus of between 4.5 and 5. And that is extremely significant. Again, that's another percentage increase. And it holds, all of these are a little bit closer together and they're held up higher. Essentially, is the expectation is higher rate hikes and a slower taper off, where they would reduce rate hikes afterward. Now, it's important to note that the Federal Reserve last year, and I was critical of them, was that they weren't doing what they were supposed to do. They were still being very accommodative, and they were still loose in their monetary policy while inflation was rising, infamously saying that inflation would be transitory, and it turns out it has not been. So in general, they should not be given the benefit of the doubt that they're going to succeed. Also looking at past Federal Reserve policies, of course, hindsight's 2020, they almost always tighten too late and tighten for too long. And that can cause recessions very easily. Now, I shouldn't have given the benefit of the doubt last year, but I felt pretty positive because their projections and their plan from all June and the previous ones at the beginning of this year seemed reasonable and seemed that it would succeed in fighting inflation and wouldn't put the economy in a recession. And last month, the month before that, I said we probably bottomed. And we might still have bottomed. We just retested the bottom, and we'll see if we break through. But I am much, much more negative than I was a month ago, specifically because of what the Federal Reserve has come out in their stances. And they've shifted to be very hawkish. They've shifted to be extremely committed to, it seems, over tighten irresponsibly, in my opinion. And I am much, much more negative, much, much more worried about the economy. Now, I should, if any of you follow economists and market watchers, one of the famous ones, he's a professor at the University of Pennsylvania, Jeremy Siegel, and he's usually pretty restrained, and I like what he says. He's often correct, first off, and second off, extremely eloquent when he's speaking. And he criticized the Fed last year, and he was on board with the Fed's plans. And it was amazing. He had a CNBC interview at some point last month. I'm sure you could find it on YouTube. And he was extremely upset with the Federal Reserve's decision. And this was after I had listened and thought basically the same thing he did. And I was listening to what he had said, and it's essentially, I'm on board. If you go to YouTube and search for Jeremy Siegel's CNBC interview, essentially what he says, just more irately than I will right here, is we're both very worried about what the Federal Reserve is doing. Now, there's two possibilities in my mind. Possibility number one, which is the hopeful one, is they're putting on a strong face, they're showing resolve, and they're saying we're going to just tamp down on inflation no matter what. And that's just to show that they have the will to do so. And that in itself affects markets because it changes the market players' expectations, and the market will tighten by itself. They'll take less risk and such. And that will make the Federal Reserve's job easier. Now, that's the hope, is that they are saying all these things with the intention of manipulating the market, but not actually going to follow through on these rate hikes that are so significant. Now, the other side of the coin, which is the more likely one to happen, is they actually mean what they say. they're going to tighten to these levels at the end of 2022 and continue into 2023. And they're going to hold those levels for too long, and the economy is going to suffer. It's important to note, again, that all this stuff is backward looking. Inflation is backward looking. The interest rate hikes have lag effects. They have to work their way through the economy. So I'm not saying that I would do a better job in the Federal Reserve. I have utmost respect for them. And it is extremely difficult to thread these needles and try to get the perfect monetary policy. But from my opinion, and from almost every opinion of market watchers that I've seen, is that this past announcement and their attitude was extremely wrong and extremely worrisome if they do follow through on it. So hopefully this backlash, essentially this outcry of worry from the community, the investing community, will have them back down a little bit. If they don't back down, what we're looking at is 100 to 125 more basis points by the end of the year. We are at the level that was expected 3 months ago for the end of the year, and we'll see what they do. Hopefully they don't over tighten. Hopefully inflation works itself out. We're going to, I'll let you know next month what this month's inflation data was. I am positive on it. I think inflation is going in the right direction. I think the economy is in a good point, and I'm very positive on all that. I'm just very worried about what the Federal Reserve is doing. They don't have a great track record. We'll see. I hadn't talked about this top chart really quickly. It's the same showing what's here is the expectation. 3 months ago was this, and that was how high interest rates would get and how long they would stay that way. And then now, within 3 months, how drastically higher the planned rate hikes are. So we're going to see what happens. One note before we hop into audience Q&A is, although I was negative and my projections are negative, and I caution my clients when investing not to invest aggressively at this point, it doesn't mean that everything is going to fall apart and everything's panic and you should sell and none of that. It's important, of course. I preach long-term investing, stay in the market, hold, be well diversified, and invest correctly in the amounts that are appropriate for your situation. And within a year or two, I feel very positive about the economy. Again, the US is seen as a safe haven for the rest of the world. We are doing better than the rest of the world. I'm complaining about the Federal Reserve, but in comparison to the rest of the world, it's incredible. Like Turkey is loosening with 80% inflation or whatever is happening. Turkey is the laughing stock right now of what's happening. The Federal Reserve, although might be missing it by a little bit, isn't doing a bad job overall. So quick audience Q&As. I only see one, so I won't keep you too long, is about the impact of Hurricane Ian on the markets. Now, in general, I would say hurricanes in the past and natural disasters don't affect the markets that significantly. They definitely can have extreme impacts on local regions, specific companies. That's why it's important to be diversified. Insurance companies can be wiped out pretty easily. Real estate companies that hold specific real estate in place can be wiped out. And it can be devastating and catastrophic to individual families, individual investors, especially if they live in those areas and such. And because they have minor impacts on parts of the economy, oftentimes they'll have minor impacts on the overall stock market and the overall economy. But I wouldn't, for you and I who live in Maryland, I think everyone, if I'm running through my eyes over the list, everyone here lives in Maryland. I don't think there's going to be too much impact on our lives, and I don't think there's going to be too much impact on the stock market as a whole. But I don't want to diminish, of course, what everyone's going through in Florida and such. is terrible, and it can have really terrible impacts on their entire livelihoods and their savings, because they have to rebuild homes and such. It's an important reminder. All of my clients, I go over their insurance coverage and such. And for those of you that self-insure or handle your insurance yourself, look at your homeowners coverage and such. Almost all homeowners insurance has specific exclusions. War, and we're not too worried about war. Earthquakes, unless you pay specifically for it. But the common one is in flood insurance. Most of us don't have flood insurance on our homes. You can buy it through a federal program, the Federal Flood Insurance Program, I believe it's called. But most of what's happening there, if it's caused by wind or rain and such, will be covered. But for all you've seen the terrible images of the waters rising 5-10 feet and flooding into the home, some of that won't be covered for a large portion of Floridians and other people. So it's an important reminder that insurance is important for your property, but not to mention the rest of insurance for those that have dependents, disability insurance, and life insurance. For those that are approaching retirement, of course, you want to look at long-term care if you can't self-insure. If you are worried about markets and such, fixed annuities, that basically is just buying a pension for yourself to guarantee life income for life. All of these are insurance products and can protect you from catastrophic events, not necessarily a hurricane, but like hurricanes. So I know not exactly market update material, but an important consideration, important to remember that your financial health and your financial picture isn't just the markets, to look at it holistically, have a financial plan in place, all of that. And if any of you in the audience would like to talk about that, of course, please reach out. So, one more Q&A. What is your opinion on the Santa Claus rally? If we keep going down on the S&P, are all bets off for one? Oh, that's a great question. So for the Santa Claus rally, it's not a guaranteed rally. And I would say it's a little bit far off to say. Likely, what I would, from my point of view at this time, is the Santa Claus rally is probably going to happen. It happens, I forget the statistic, but it's like 9 times out of 10. It's up in the 90% range or something like that. And the Santa Claus rally will likely help recover some of the losses at the end of the year. It might be significant. It could be 10%, 15%. It also could just be 2%. And 2% is still a nice rally. I'll take 2%. However, just because I expect a Santa Claus rally at the end of the year doesn't mean there's going to be terrible pain until then. Right now, we retested the bottom. So if you look at a chart, there is basically a perfect hump. And we're back at that 3,800 bottom. And I could see with my negativity with the Federal Reserve, especially if this month technically, in mid-October, they come out with a very hawkish tone, and they're continuing on their war path against inflation. We could break down through the bottom. I don't think we're going to be in free fall. I don't think everything's going to crash, but it can definitely be significant. And we might be down, say, 10%, and then the Santa Claus rally could be up 5%. So from now until the end of the year, it might be, you might lose money if invested right now. But there is a likelihood that near the end of the year, we'll have a rally, bring this back up. The last 3 quarters usually have a beneficial effect on the markets. So looking positive for the end of the year, except for the whole Federal Reserve thing. So it's kind of a gamble. And next month, I'll let you know what the Federal Reserve does, and hopefully it's good news. All right, I think that is it, everyone. Thank you so much for attending. And I hope to see you guys all next month. See ya.